Hi, I'm Jay Prakash. Welcome again to our series on smarter fixed income investing with bonds. Today, we will debunk some of the myths around bond investments and why they are a key to a balanced portfolio. Do you think high volatility assets like equities, gold, or cryptos always deliver the best returns? Think again. While these asset classes can produce impressive gains, bonds can sometimes quietly keep pace with them, offering comparable average returns over longer periods but with significantly less risk and volatility. You've probably heard the saying, high risk, high returns. But here is the reality. Taking more risk does not always guarantee higher rewards. Sometimes safer choices hold their own, and over shorter time frames may even outperform. In this video, we will move beyond assumptions and take a closer look at the real numbers behind this common myth. Let's look at the performance of equity and gold over the last 10 years. Over the past decade, both equities and gold have delivered competitive returns at times. But neither asset has offered consistent, smooth performance year after year. Equity returns have experienced significant swings, from a negative return in 2015 to a 28% return in 2017, highlighting that growth in the stock market is not always linear or predictable. Even gold, often viewed as a safe haven, has shown its own volatility, with a sharp drop of negative 11% in 2015 and a dramatic climb of 47% in 2020. Over the last 10 years, gold achieved a compound annual growth rate of only 12%, slightly exceeding the Nifty 50's 11% CAGR for the same period. If you widen the lens, the Nifty 50 has delivered a robust CAGR of about 13.9% over 15 years, underscoring its long-term growth potential despite short-term bumps. These ups and downs illustrate that consistently predicting volatile asset classes' performance and when it will go up or down is extremely difficult. Now let us take a closer look at bonds. Investment-grade bonds, which are AAA rated to BBB minus, offer steady returns, typically between 8 to 14% without the wild swings of the stock market. A-rated bonds yield around 10%, while a BBB-rated bonds can go up to 14%, depending on the risk and tenure. Some bond portfolios have even matched or beaten equities on a risk-adjusted basis. Similar returns, but with a far less stress. But keep in mind, bonds carry risks like credit risk, liquidity risk, and interest rate risk. So they are not completely risk-free. Let us take a real-life example. Rahul invested 10 lakh in the Nifty 50 in 2015, and Priya put the same amount in an A-rated corporate bond. After 10 years, the returns would have been very similar, but Rahul faced the emotional roller coaster of market ups and downs, while Priya enjoyed steady monthly income and peace of mind. Bottom line, bonds often provide smoother, more predictable returns, making them a great choice if you want defined growth without the stress. Let us take an Indian investment reality check. Let's call it like it is. Most Indians still park their money in fixed deposits. Safe? Yes. But FDs rarely outpace inflation, so your returns may not keep you afloat, not help you get ahead. Real estate looks attractive on paper, but it's illiquid, expensive to enter, and filled with legal complexities. Even then, a 10-year CAGR is just about 12%. Hardly a reason to put all your eggs in one basket. Gold works as a great hedge, but as a growth asset, it's inconsistent. For the last decade, its cumulative annual growth rate has been around 12%, with volatility to match. Crypto? Let's be honest. It's more of a high adrenaline bet than a serious long-term plan. Now consider bonds. They offer stable and predictable returns, often between 8 to 14%, depending on the rating and structure. Bonds are liquid, transparent, and ideal for short to medium term goals. We are not saying you should ditch equities, real estate, or gold. But ignoring bonds is a mistake. Bonds are an essential asset class that diversifies your risks, cushions your equity volatility, delivers stable and competitive returns. No matter your age, risk appetite, or financial goals, bonds deserve a place in your portfolio. The allocation may vary, but the relevance does not. It's time bonds got the spotlight they deserve. Well, are bonds only for conservative investors? Think again. Bonds fit every risk profile, from safe government securities to high-yield corporate bonds. They provide diversification, stable returns, and suit short to medium-term goals. Well, what about risk? According to CRISIL's 3-year cumulative default rate over the past 10 years, AAA-rated bonds have a nearly 0% default rate. A-rated bonds have a 3-year cumulative default rate of 0.66%. BBB-rated bonds have a 3-year CDR of 2.21%. This risk level is lower than you might expect. It's time to rethink your portfolio. If you invest only in equities, FDs, or real estate, consider adding bonds. Smart investors balance the excitement of equities with the reliability of bonds to grow wealth confidently. And thanks for watching. We'll see you in the next episode.